You hear the word deck, and you might immediately think of, I don't know, Maso bamboo outdoor decking materials. But today we're putting on our skeptical equity research analyst hats. We are investigating the massive footwear powerhouse behind the stock ticker DECK, Deckers Brands.
We've got a massive earnings paradox on our hands today. Look at this. Deckers just posted a completely record-breaking first quarter. We're talking a massive revenue beat, a huge earnings per share beat, and yet the stock absolutely tanked 14% in after-hours trading. Make it make sense, right? Well, let's dive into this explainer and figure out exactly why Wall Street reacted this way.
But first, before we start our forensic analysis of the financial statements, we have to get through the mandatory compliance disclaimer. Here it is. This is an educational case study in quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
All right, here's our roadmap for today's earnings autopsy. We're going to hit the immediate paradox, dissect the brand mode, uncover some hidden red flags, and finally, ask if this is a value trap or a true opportunity. Section 1. The Paradox. Let's start by looking at the surface-level numbers that completely dazzled the financial headlines. So $1.02 billion. For the very first quarter in its entire history, Deckers crossed the billion-dollar quarterly revenue mark. That is a 5.7% jump year over year. Literally a million miles away from its 1973 origins when the founder was selling flip-flops at West Coast craft fairs.
And they weren't just moving inventory, they were highly profitable doing it. Adjusted earnings per share came in at $0.94. The crazy thing here? That utterly crushed Wall Street estimates of $0.87. That's an 8% upside surprise. So revenue hits expectations, earnings go through the roof. Why did the stock plummet? Well, to figure that out, we have to look under the hood.
Moving to Section 2, Dissecting the Brand Moat. Let's see what's actually powering this cash engine.
Deckers basically runs a brilliant dual-engine portfolio strategy. On one side, you have UGG, the premium lifestyle and comfort brand. It's a massive legacy cash generator expected to grow steadily in the mid-single digits. On the other side, HOKA, the premium performance running brand that's acting as their global hypergrowth engine, targeted for low double-digit growth. It's a really smart, balanced setup. And here is how that actually played out in Q1. HOKA is just tearing it up, taking the lead with $704 million in revenue. That's up 8% year over year. But UGG isn't slouching either. For a legacy brand, pulling in $278 million and growing 5% year over year is incredibly resilient. But it's not just what they're selling, it's how they're selling it. A huge part of their economic moat is this aggressive shift to direct-to-consumer, or DTC channels. Basically, they're cutting out the wholesale middlemen. In Q1 alone, global DTC revenue shot up 13%, HOKA's DTC was up 17%, and UGG's up 6%. By selling directly to you and me, they keep their premium pricing, they hoard all that valuable consumer data, and most importantly, they pocket way higher margins.
Now for Section 3, Red Flags and Margin Threats. If the brands are so strong, why the 14% drop? Let's act like investigative journalists for a minute and dig into the footnotes.
When you ignore the flashy top-line hype and actually read the earnings call transcripts, you find these hidden media blackout margin threats flagged right there by the CFO. First, their assumed tariff rate is jumping from 10% to 12.5%. That definitely hurts. Second, they are warning of looming freight cost pressures in the back half of the year. And third, and this is the big one, massive wholesale shipment timing anomalies.
Here is the crucial takeaway. A huge chunk of that amazing Q1 gross margin beat, it was basically a mirage. It was a timing anomaly. Some of the growth was literally just European wholesale orders returning to a normal schedule after a warehouse transition they had last year. Add in some favorable closeout product management that absolutely won't repeat, and Wall Street realized this wasn't a permanent demand spike. It was a localized Q1 tailwind about to smack right into a Q2 headwind of tariffs and freight costs.
Finally, Section 4, Value Trap or Opportunity. Let's run a reality check on the fundamentals.
Let's start with the balance sheet. Debt? Zero. Absolutely zero outstanding debt. In today's era where consumer brands are just suffocating under high interest rates, Deckers is operating with a pristine, totally clean slate.
Plus, they are sitting on a dragon's hoard of cash, $1.6 billion in cash and cash equivalents. That gives them incredible agility to weather any macro storms. And they aren't just hoarding it either. They bought back $338 million of their own stock just last quarter.
And look at this profitability, a trailing 12-month gross profit margin of 57.7%. Even with those looming freight and tariff threats, that is elite tier. It is one of the highest profitability levels in the entire footwear industry, which just proves their immense pricing power.
When you combine zero debt with sky-high margins, you get an exceptionally efficient 41% return on equity. That means management is incredibly disciplined with capital. They aren't burning cash on vanity projects. They are laser-focused on high-return brand growth.
So looking at valuation, they've got a forward PE ratio floating between 12 and 14. Guys, that is incredibly modest. You are basically getting a hyper-growth profile priced like a boring value stock. Top-tier metrics, zero debt, the HOKA engine, all at a totally reasonable multiple.
So, this is where we land. The quantitative models point to a deeply undervalued stock with a massive brand moat. But those hidden tariff flags and timing shifts, they clearly signal a looming margin storm. The fundamentals are undeniably strong, but the near-term waters look pretty choppy. The models are pointing one way, but hidden flags suggest a storm. So as you go do your own homework, which side are you on?